Good afternoon. My name is Dennis Brooks. I'm a graduate student here at UAB. I'm an accounting tutor in the COLAT Business Lab. Today we're going to talk about Chapter 3. It is much like Chapter 2 in that it involves very similar problems such as unadjusted trial balances, adjusted trial balances, financial reports, and other such issues as were contained in Chapter 2. Where we will be differing from our presentation in Chapter 2 is in the depth and a more formal approach to those accounts and statements. We also will be introducing several new concepts such as accounting periods, accrual-based accounting versus cash-based accounting, and accounts such as unearned revenue, prepaid expenses, depreciation, accumulated depreciation, and some other accounts as well. I'm going to start off with accrual-based accounting. Uses the adjusting process to more closely approximate the timing of when revenues were earned and expenses were incurred. If you remember from Chapter 1, that follows with the revenue recognition principle and the expense recognition principles of accounting. Cash-based accounting recognizes revenue when cash is received and expenses incurred when cash is paid out. Cash-based accounting is not consistent with generally accepted accounting principles. This is also known as GAAP. Get used to that one, you will see it a lot. And thus, it cannot be used as an accounting method for a publicly traded company. All of the FASB's accounting rules apply only to publicly traded companies. Now, most private companies follow those because the banks will want a GAAP-compliant balance sheet of your company when and if you try to apply for loans. We're going to move on here to prepaid expenses. Prepaid expenses are expenses that you pay in advance of incurring them and thus are counted as an asset. Typically, prepaid expenses concern three primary accounts: prepaid insurance, prepaid rental expense, or prepaid supplies. Now, supplies seems like a strange one to call a prepaid account because typically you just go out, buy the supplies, and buy it with cash. But it is technically on your balance, on your adjusted trial balance, your unadjusted trial balance, and other statements as a prepaid supply. But they do not typically use prepaid. I'm just mentioning the prepaid part so that you understand that there are three accounts that are typically considered prepaid. These prepaid expenses are credited as you accrue the expense associated with that account, and the offsetting debit is the expense to which that account is linked. I made a mistake here. This is not credit, this is debit. Okay? Now we're going to talk about unearned revenue. Unearned revenue is the exact opposite of what prepaid expenses are. This is where a company has paid you in advance for services you have not provided yet. Thus, it is counted as a liability account where revenue that has been paid in advance to your company and has not been earned yet. This account is debited as service is rendered, which turns the funds stored in that account from unearned revenue to credit to the appropriate revenue account. Depreciation. Depreciation is a very important concept. This is how you capitalize the cost of PP&E, plants, property, and equipment. Depreciation is an account that is linked to PPE items that are long-lived and capitalized over time. As depreciation is accounted for, it transfers at the closing of a period to a contra-asset account. A contra-asset account is kept exactly the opposite way of a asset account. Typically, in an asset account, you debit it to add to it, you credit to take away from it. But because it's a contra-asset account, this account, very specifically, accumulated depreciation, you credit it to increase it and debit it to decrease it. Once you take the depreciation that you occurred for over that time period, You take you transfer the depreciation to the accumulated depreciation and the depreciation expense account. Now what we're going to do is look here at forms, what we call pro forma. That means they are prepared in the way that they are meant to be. I'm going to step out of the frame for a second because I want to get my cane so I can point at something to you that's very important. Got a bad back, old man. I don't walk as well as I used to. If you see up here, Choi Company, adjusted trial balance, December 31st, it's centered in the exact middle of this statement. This is very important. If you do not do it exactly in this order as it is shown here, that can be counted off on your exams. Now what we're going to do is, this is a problem straight from your book. It's demonstration problem 2, which is located later in your chapter. This is for the Choi Company, and they've already done the adjusting trial balances. Well, in chapter 2, we did a pretty good job of showing you how you went from an unadjusted trial balance to an adjusted trial balance. So again, what we're concentrating on is the proper presentation of the statements now. So as you can see, you have cash debited properly for $3,050 in your assets. You have accounts receivable for $400, again properly debited in its account or asset account. You have prepaid insurance. I put prepaid here on supplies in parentheses because it's just letting you know that this is a prepaid account, but you would actually take the prepaid out when you were presenting this on the pro forma statement. We have equipment for $217,200. We have accumulated depreciation of this equipment of $29,100. You would take this amount from that amount to when you get further down to apply where your proper expenses and assets will go. We have wages payable. These are an expense, thus they are credited to increase them. You have wages payable, you have interest payable, and we have another account that we talked about, unearned rent. This is obviously a rental company, and what they have going here with their unearned rent is they have $460 that a tenant of theirs has prepaid them. We have long-term notes payable of $150,000, again, properly credited on the credit side. Common stock, we have $10,000 worth of shares outstanding. Retained earnings, at this point in time, at the beginning of the year, $30,340 was our retained earnings. Dividends. Dividends are payments that we make out to the stakeholders in the company, and our dividend is $21,000. Again, properly credited because it is a account on the equity side that is to show that this is being paid. You would debit it, and then to remove it, you would credit it. We have rental revenue. This comes from the unearned rent up there. This obviously they had $57,000. Now, a completely legitimate question off of your exam may be, what was your starting unearned revenue? And you would be able to very easily tell. You would take your unearned revenue and add it to your unearned rent. And you would take your rental revenue and add it to your unearned rent. Those are question types that may be asked. From the prepaid insurance account from up above, we have insurance expense. That means we have used that insurance, so we have taken it out of its prepaid account and put it into its expense account. Supplies expense, again, we had the prepaid supplies and then we have what our supplies expense. Again, perfectly legitimate question is, tell me how much we had in supplies at the beginning of the year. You take your supplies expense, add it to your prepaid expense account, and you are there with the answer. Now we have depreciation expense. Remember when we talked about we were taking depreciation and adding it to accumulated depreciation? Accumulated depreciation is there for the life of that particular piece of plant, property, and or equipment. So they obviously had $5,970 in depreciation expense. They also had interest expense on that note payable of $3,000. So if you add up both sides of this, you'll see that we've come to the same amounts on both sides. That means our debits and our credits match up. Now, does this mean that a mistake has not been made? No, it does not. Does this mean that all of the accounts have been put on there? No, it does not. It just means that what you have done thus far has matched up and balanced. You could have accidentally forgot an expense and then not had it credited where it needed to be, and you would find out that while this was technically correct, there would still be an error. But this is what an adjusted trial balance will look like. Now, if we can go to our next set of slides, we're going to show you can you bring this over one more, please? Or two more? Yes. No, the income statement. Okay, we're just going to have to use it from here. Again, if you will notice up here, Choi Company, income statement. This is very important. For year ended December 31st. There would normally be a year saying what year it was, but this is just a practice, so we aren't timing a year to it. But in your exam questions, they may very well give you a year, and you need to make sure that after that you put the year down after the date. Okay, so from the previous account, or from the previous adjusted trial balance, we know that our revenues are $57,500. And the way that you come up with your, can you scroll down to here to where I can see the next one down from this one? Where you get your net income is taking your rental revenue minus your expenses to get what your net income for the year was. So we had $57,500 in revenue, and then we had these amounts in expense. Notice depreciation expense for the equipment. That is now counted as an expense as we have put it in there, and it has been added to the accumulated depreciation account as well. So you've got $5,970 there. You've got the interest that you paid on your notes payable. Our total expenses from wages to interest was $39,320, and that leaves us with a net income of $18,180. We're going to go next to the retained earnings. We have, again, this is another one of those where you have to pay attention to the way that you title it. You look up here, Choi Company, Statement of Retained Earnings for year ended December 31st. The exact same rule applies here as it was here. You have to present it exactly this way, and if they give you a year, it goes there after you've done it. So retained earnings, if you remember from back on our adjusted balance, prior year end, which means December 31st last year, was $30,340. We added in our net income of $39,320, our $18,180. Add that to net income there. We now have a new retained, or what our income is, and then we pay dividends on this. Dividends of $21,000 were paid. Dividends, as we explained before, are cash payments made out to stakeholders. So dividends decreases your net income in your retained earnings statement. So we went from $48,520 minus $21,000 to our new retained earning balance of $27,520. And we'll go to one more. This is the balance sheet. Again, has to be presented exactly the way it is. An interesting fact about the balance sheet, it is only good for that one moment in time that you did it. One transaction occurs and that balance sheet is no longer good. So it is a snapshot of where the company is at the moment in time that you prepared it. So we're going to go up here and we're going to look at our assets. If you remember in the accounting equation, assets equal liabilities plus expenses, or liabilities plus equity. So we have cash assets of $3,050. We have accounts receivable for $400. We have that prepaid insurance account with $830 on it. All of these numbers that I'm giving you came off of the adjusted trial balance from the very beginning. You have prepaid insurance, you have prepaid supplies. Again, I put prepaid there just so that you would know that is considered a prepaid account, but normally you would just present it as supplies. We have equipment of $217,000 and $217,200. Less accumulated depreciation, if you remember our accumulated depreciation, plus the depreciation from this year, that is what this amount is, and that will give you this amount of $188,100. So our assets are worth a total of $192,460. Can you scroll to where liabilities is at the top? Thank you. Okay. Liabilities. We have a liability on wages payable. What that means is that wages were earned from the previous period are being carried into the next period because they haven't been paid yet. Interest payable. Unearned rent. Again, we talked about that account. Long-term notes payable. This is the account where the interest was being paid from. We have a total in liabilities of $154,940. So now we're going down to equity. Common stock, which we talked about on the adjusted trial balance, $10,000. Shares outstanding. You have retained earnings from the previous statement of $27,520. Total equity means you have $37,520 in that entire equity account. You then add total liabilities and equity, and that will give you the $192,460, which balances out to the total assets of $192,460. Again, my name is Dennis Brooks. If you have any questions, you can reach us online at colattutorlab.uab.edu, or you can Skype with us at Colat Tutor Lab on Skype. Thank you.